Financial Modeling, Topic 4, Portfolio Risk Return Optimization, copyright Lou Gaddis. In this topic, we're going to talk about how to create efficient portfolios with and without short sales, and also talk about portfolio risk and return. We'll compute efficient portfolios, ones that maximize return or minimize risk, and we'll also combine those portfolios with risk-free assets and leverage or borrowing. So we'll take our spreadsheet here. I've posted, and here are my assumptions. Let's pretend there are three major asset classes, and these are actually taken from my estimates of the expected return of the U.S. stock market. Here's an ETF SPY, an EAFE fund with an ETF that tracks at EFA, and an emerging market equity fund with this as an ETF that tracks at EEM. And here are my estimates for expected return over the next year or so for those assets. I use Global CAPM, which was covered in another topic. And here are my estimates for these assets of volatility. So it's about 1 year annualized standard deviation. So I'm expecting the volatility of the U.S. market to be 16, 18 for EFA, 25 for EMA over the next year or so. And I got that from looking at implied volatilities of 1 year calls and puts. And let's just start with an equal weight portfolio of 1/3 each. I've also used 10 years of SPY, EFA, and EMA correlations. So here are my correlations between SPY and EFA, 89. SPY and EMA, 0.54, and EMA and EFA, 0.61. Based on that, I can then calculate a covariance matrix. So these are the covariances between the asset classes. Each covariance is the standard deviation of the asset, or the two assets, times the correlation. So that's my covariance matrix. We covered that again in the last topic. And lastly, the portfolio mean would just be the sum product of the means and the weights. And I have a named range. These are my means, these are my weights, and that's W. So I got sum product of the means and the weights. And the portfolio standard deviation using matrix algebra is the M-mult transpose WSW, which takes into account these vols or these weights and the covariance matrix. I created some named ranges. This is the portfolio mean. I called it mean. Here's the portfolio vol. I called it volatile vol. Here's the sum of the weights, and I called it W sum. I created several more named ranges. Here is RF, the expected return of the risk-free asset, 2%. Here's the borrowing rate of 5.5%. That's RB. And I created some name ranges in these blank cells, sharp and B sharp. And I also have links down here. It's going to make our lives a little bit easier when we do some copying and pasting later. Here's a link to the portfolio vol, a link to the expected return. Again, make sure that these are linked and not values. A link to the weight of SPY, a weight of EFA, and a weight of EMA. So if I could hold any of these assets in isolation, say put all my money in SPY, EFA, or an EMA, what I'd rather do is build a portfolio of these assets. If I just took an equal weight portfolio, that would be the expected return 7.5. And a standard deviation 17.34. But what I can try to do is I can build optimal portfolios or efficient portfolios. Efficient portfolios are those that maximize return or minimize risk given constraints on the other. A set of efficient portfolios is called an envelope or efficient frontier, and you find that by running Excel Solver. So I've set up 5 returns I'd like to find efficient portfolios. I want to find the efficient portfolios for levels of return of 6, 6.5, 7, 7.25, 7.5, and 7.75. So what I'll do is I'll run Solver, Data, Solver. I'll just hit Reset. And I want to find a portfolio that minimizes vol. Again, vol is the standard deviation of the portfolio calculated up here. By changing the 3 weights, those 3 weights are 33% right now. That W is that vector of 3 weights or named range of 3 weights. I want to add a constraint that my sum of the weights are equal to 100% or 1. So that makes sure that all the money gets invested. And then I'll add one more constraint that my portfolio mean, which I gave a name range of mean, which is right here, that has a value of 0.065, 6.5%, which is just a value I picked to try to optimize. So I'll run solver, and it said solver found a solution. The best 6.5% mean portfolio is actually 100% of your money in SPY, and that actually had to be the solution, because anytime I add these higher return portfolios, you no longer can get a 6.5% mean. So it just turns out to all your money invested in SPY, which gives you a mean and standard deviation of SPY. I'll go ahead and copy these links here and just put them down here as I start collecting efficient portfolios. And I'm going to paste special value, but I'll use Excel's shortcut for that, Alt HVV, and that just takes this row here and copies it down here as values. Now I'll run solver, so 1, 2, 3, 4, 5 more times, and each time I need to change the mean to 675 to 7 to 7.25 to 75 and 775. So I'll do data solver, and I'll change that 6.5 to 7, and I'll run solver found a solution, and I'll just copy these values, Alt HVV to paste, and I'll run it for a level of, whoops, I was supposed to do that. That one is 7, so let me copy that one here. Copy, Alt HVV. I meant to do 675 here, so let me just do that one. Data solver. Let me change this value to 675. Solve. Okay. And let me just take those values and put them here. Alt HVV. So here's the best 6.5, 6.75, and 7% mean portfolios. Best meaning it's efficient, minimizes volatility. So let me run 7.25. Solve. I'll copy this row. Alt HVV. Change it to 750. Solve. Okay. That's the best 750. Alt HVV. And the last one. Copy, Alt HVV, paste special value. So these are a set of efficient portfolios, the best portfolios I can build of these 3 risky assets for levels of return of 6.5 to 7.75, incrementing it by 25 basis points. If I highlight this data and insert a chart, I'm going to insert a XY scatter with a smooth line. This is now my envelope, or efficient set of portfolios. Efficient in the sense that they minimize standard deviation for different levels of mean. So, for example, if I were to just add, say, EFA to this chart, it just so happens that this is SPY down here, and this is all of EEM here. So if I add EFA to this chart, I'm just going to right-click, select data, add, and I'll put EFA as the name, has a standard deviation of 18%, and a mean of 675. What you see is EFA is now dominated. Let me just change the format of this graph a little bit. Design. And I'll add some axes. That is the mean return. And that is volatility. So here's my envelope, and what you can see right away is IFA is dominated. I would rather invest in, say, this portfolio here, which is the second portfolio, which combines SPY and EMA, because that portfolio has less risk, right, going from 18 down to 16, with about the same mean return along this line. So it's clearly a better asset than, or this portfolio is clearly dominating IFA. And this one right here is clearly dominating IFA also. I see a portfolio on this line right here. I would rather have this asset here on this line, which would be, say, higher level of return for the same level of risk. Actually, you can see this one clearly dominates. This third portfolio has actually less risk and more return. That third portfolio is 55% SPY, 7% IFA, and 39% EMA. So what you see right away is by combining assets into portfolios, the diversification benefits of holding assets together that are not perfectly correlated can give you a dominant portfolio. So this is actually a free lunch, right? Some people say there's no free lunch in finance or economics. Well, there is one free lunch, and that's diversification. All right, there's no trade-off between risk and return in this case. I can get a portfolio that clearly has less risk, the same return, and clearly, in this case, a portfolio has more return and less risk. That is a free lunch. So you're really missing out if you don't diversify into many assets. And I'm going to change this axis here, and let me just have it start at 0. It's not going to look as pretty when I'm done, but let me just right-click there, Format Axis, and start that at 0. All right, so now we see our envelope, and then IFA. And now the next thing I'm going to do is talk about what happens if we add a risk-free asset to our portfolio choice. If there is a risk-free asset that provides 0 standard deviation and a positive return, I can combine it with one of these risky envelope portfolios I've found. And the combinations of the portfolios will plot along a straight line. The reason why it's a straight line and a curved line is there's no diversification benefit from holding a risk-free asset and a risky asset. When you hold risky assets together, you get a bowed combination line. That's because the volatility is bowing inward as you combine them, and their risk is falling. But when you combine a risk-free and a risky asset, it plots along a straight line. That's because the standard deviation of a portfolio that combines a risky and risk-free asset is simply the weight in the risky asset. So if I were to, say, draw a line here on my graph that I've created, and the risk-free rate were, say, 2%, let's see if I can make that a little thicker. That if I were to, say, combine, I'm going to make this a little bit bigger. If I were to combine, say, or if I were to hold, say, only a treasury, I'd earn 2%, so I'd be right here on the line. But I can combine, say, treasuries and IFA, which is this line, and I can get anywhere along here. So, for example, this would be a portfolio. This midpoint here would be, say, half my money in treasuries and half my money in IFA. But I wouldn't want to hold IFA with treasuries because I could, say, hold this portfolio and treasuries on the envelope. That is clearly better, higher return per unit of risk. But I wouldn't want to hold that one either. The only portfolio I want to hold with treasuries would be a tangent portfolio, a line or tangency of a line that extends from the risk-free rate to the envelope. So this portfolio right here, whatever it is, we'll have to find it, clearly dominates these other portfolio combinations. So the thing I'm going to try to do is try to find this envelope portfolio. That's the one I'll combine with Treasuries, not EFA or SPY or one of these others. All right, this one out here is actually EMA. I definitely wouldn't want to combine EMA and Treasuries. I want to move in this direction. So I'm going to find this portfolio right here. And how I do that is I set up the equation for slope of this line in Excel and then run a solver to maximize that function by changing the weights. So you can notice the slope of this line that extends from the risk-free rate would be the return on the portfolio, say 7 in this case roughly, minus the risk-free rate, say 2, over the standard deviation of this portfolio. So it's your rise over your run. So let's go ahead and put the formula for the slope right here. It's going to be equal to the mean portfolio return minus risk-free rate over the volatility of the portfolio. So that would be the Sharpe. In finance we call that the Sharpe ratio, named after William Sharpe. And right now that was our last solver we ran. So the last portfolio sitting there is all EMA. So really it's given me the Sharpe ratio, or the slope of this line. I'm going to run solver, and it's going to tell me what this portfolio is. So let's go back to solver, data, solver. I'm going to maximize the Sharpe ratio. By changing the weights. Sum is equal to 100%, but I'm going to delete the constraint on mean because I don't want to constrain it to any particular mean. I want it to have any mean variance, mean volatility combination that maximizes the slope. Solver found a solution. So this is the optimal portfolio, which is 76% SPY, 23% EMA, no EFA. Gives me a 6.8% return and 16% vol. I'll copy those links, and I'm going to paste them down here, Alt-HVV for their values. So I'm going to call this my optimal risky portfolio. Here's a link to my treasury. So what I'm going to do is I'm going to add these 2 data points and these 2 data points, and it'll plot a line. It'll connect the risk-free asset and the portfolio I just found. So how I do that is I'm going to go back on my graph, do a right-click, select data, and I'm going to add a series, call it CAL for capital allocation line. That is how capital is allocated between risky and risk-free assets. The X variables are going to be my 2 standard deviations, 2 vols, and my Y, let me delete that out of there, are my 2 returns, and I hit OK and OK. And so now what you see in the graph are my portfolio combinations of risk-free and risky that appear to form a tangency. Now if I were to blow this up a little bit, what you could see is this portfolio is combinations of the risk-free asset and this portfolio clearly dominate this part of the envelope. So I'd never actually want to invest on this part of the envelope if there's a risk-free asset. Any portfolio volatility less than this number here, which we just calculated, I would be combining treasuries in this portfolio. And then if I want more risk or return than this point here, I would just find another envelope portfolio. So my choice of portfolios now would be this line segment, combining treasuries in this optimal risky portfolio, or a point on the envelope, one of the 6 solvers we ran before. Notice also I'm not going to graph this part of the capital allocation line, because this part of the capital allocation line, I'm going to go back to my graph, I'll show you that. Right, so what I'm not going to do is graph a capital allocation line that extends past this point here. So let's talk about what, say, this point here would represent. So if I extended the line, this point here would pretend or estimate the expected return and standard deviation of a portfolio which borrows money at 2% and leverages a portfolio here to get to this point. All right, so for example, this portfolio might represent a situation where I have $100 and I borrow $25 at 2% and put $125 in this portfolio, that will get me a point, say right here. But I can't borrow at treasury rates. So my line is going to stop right here, and that's why if I want more risk at return, I just can't extend along this this line. I have to move along the envelope. However, if you can borrow at some interest rate, say RB, I could leverage another portfolio, namely a tangency from a ray or line coming from RB. So, for example, what if the borrowing rate were 5.5%? I could borrow money at 5% and maybe leverage IFA, which is this point here. So this point out here would represent borrowing money and leveraging an investment in IFA. But clearly that's not good enough. I would rather be at a point, say, up here. I'd rather leverage a portfolio in this neighborhood, because that's definitely better than ones that are lower return. So the next trick is to try to find what the tangency is from a line that extends from the borrowing rate, and that's the portfolio I want to leverage to get higher levels of return. So back to our area here. I have a thing called B sharp, which stands for borrowing sharp. And I'm going to put a formula in there. Let me actually copy the sharp formula down, and all I do is make one change. The mean portfolio minus RB over vol. So that's my slope of a line extending from RB. All right, the last thing I ran was this portfolio here. So currently in the data, I'm getting the slope of this tangency portfolio here. But I want to run a solver and find this point. So I'll run solver, data, solver. I want to maximize B sharp by changing the weights. Total investment is 100%. So this is the optimal borrowing portfolio. It's 5% SPY, 25% IFA, 70% EMA. Gives me a return of 744 and a standard deviation of 2109. Copy. And I'll paste that over here. Alt HVV. So this is my portfolio I want to leverage. Now I want to add this to my graph, but it's tricky because I don't want to just add RB and the new portfolio, because that'll just give me a line that looks like the old line. All right, I cannot get on this line segment, because this would pretend or estimate if I could invest money risk-free at 5.5. I can't. So I only need to be able to show this part of the line. All right, again, it's a line coming from 5.5 that forms a tangency, but I only want to show this part, which is my feasible set, which is leveraging this portfolio. So to do that, I just need to make up an arbitrary leveraged portfolio and then plot the 2 points. My arbitrary leveraged portfolio is one that's leveraged 150% of this portfolio we just calculated. And we know that if we combine a risky and risk-free asset, the standard deviation of that risk-free asset is just the weight in the risky, and say I leverage 150%. I'm going to get 150% of this volatility. So again, let's think about what this means. If I had $100 and I borrowed $50 to invest in this portfolio, I'd say that portfolio is leveraged 150%. I get 150% of the risk of that portfolio. That's what the 150 is. Now if I copy that formula over, that's 150% of the return of that portfolio. I do not get 150% of the return of the portfolio because I have 50% of my wealth minus 0.5 is borrowing money at 5.5%. So this part here is effectively the interest charge of my 50% leverage. So I'm only going to get an 8.4% return. So I get 1.5 times the risk, but less than 1.5 times the return. Now I can add these 2 data points and these 2 data points and see the line segment. So I'm going to right click, on my graph, select data. I'm going to add, I'm going to call this CAL borrowing. I'm going to add an X series of these two volatilities and these two means. And now you see my second capital allocation line. So now my portfolio choice becomes more interesting. If I want less risk or return than this first optimization on Sharp, I will combine that optimal risky portfolio that I calculated and treasuries and get along this line. If I want more return than my optimal borrowing portfolio, I'll invest along this line segment. If I want a rate of return that's between that risk and return and this risk and return, I'll run solver to find another envelope portfolio. So I made up three scenarios. Say I'm looking for a volatility of 18, 9, or 27. All right, so we'll call these portfolios V1, V2, V3. I want an optimal portfolio that combines borrowing, treasuries, and the risky three assets that provide an optimal 9, 18, or 27% vol. That means I'm going to find a portfolio at 9% vol, which is about there, and I'm going to find a portfolio on this line. I'll find one with 18% vol, which is about here, so it would be this point. And this point. And then on 27% vol, you want a high volatility portfolio. All right, so I'm going to find these 3 points and show how to get on those three, to invest in those three portfolios. One thing to notice, most people don't know how to talk about volatility, so let's put 9, 18, and 27 in perspective. The S&P 500 roughly has a volatility or standard deviation of about 16%. So this is kind of like an average risk portfolio where all your money is invested in equities. This one has about half the volatility of the S&P 500, and this has about 50% more of the risk of the S&P 500. Now, if you think about what financial planners do, you would go into an office and they don't ask you what standard deviation are you comfortable with. They might give you a questionnaire that asks, how often do you check your stocks? How would you feel if you lost 20% of the value of the portfolio? Does the stock market feel too risky for you? And then from answering all those questions, they map your responses, which is kind of a risk tolerance, to different volatilities. So after taking some kind of survey of risk, they might determine that your optimal risk is 9 or 18 or 27. But let's say you decide it's 18. You want an 18% volatility portfolio. Well, that happens to be in between these two optimal portfolios. So what I need to do is run a solver and just find one of the envelope portfolios that provides 18% volatility. So I'm just going to run data solver. I want to maximize mean portfolio. Again, just getting an efficient portfolio that has a volatility of 18%. And I'll solve. So here's my portfolio. 711 mean, 18 vol, 41, 11, 46 weights. I'll paste those down there. Alt H V V. And actually, let me slide these weights over because they are match up. So, and let me clean up. Let me change this into that's a calculation. Home data style. That's actually, let's make that an input since it's a value. And actually, let me copy these formats here. Control C, and the shortcut to paste as a format, Alt EST. enter. So the optimal portfolio, if you want an 18% vol, is investing none in treasuries and not borrowing. It's just putting 41% of your money in SPY, 11 in IFA, and 46 in EMA. So if you have someone that wants to earn an 18% vol, you're going to suggest a portfolio that's on the envelope right here. And if they had $100 to invest, you would put $41.94 in SPY, $11.58 in IFA, and $46.47 in EMA. And I'll just add that to the graph, make sure it looks right. So that's called V1. Right click, select data. Add. Portfolio V1 with that volatility and that mean. And hopefully it shows up right here, which it does. You can see it right there. Now, to get a portfolio with 9% vol, that's a very safe portfolio. That's going to be one that combines this portfolio here, which we already calculated, and treasuries. How we compute that is we use our equation that the standard deviation of a portfolio that combines risky assets and safe assets is simply the weight in the risky asset times the standard deviation of the risky asset. If I rearrange that equation, the weight in the risky asset is the combined divided by the risky asset volatility. So if I want to combine volatility of all my assets to be 9, and the standard deviation of the optimal risky portfolio is 16, I just need to put 54% of my money in the risky portfolio and 45% in treasuries. So let's go ahead and do that. So let's calculate the weight of my portfolio in risky assets. It's going to just be a ratio of 9, my combined volatility, over the volatility of the risky portfolio. So I'm going to put 55% of my money in risky assets. 1 minus that in risk-free. I'll copy that format. Now the expected return of that portfolio is it's 45% earns the risk-free rate, and 55% is invested in this portfolio that has an expected return of 6.8. So that portfolio has an expected return of 466. And then the last step is, well, how do I form that portfolio? Well, 55% of my money, I'll anchor that, is invested in a portfolio that's 76% SPY. So 42% of my money actually winds up in SPY. Just change the formats there. Notice this calculates that I have fully 100% of my money invested. So let's talk about that portfolio. Let's add it to the graph. Let's make sure it shows up in the right place. It better show up right here. So let's take a look. Change that format. Let's just add that graph or that asset. Select data. Add. Called V2. Has this volatility and this mean. And hopefully it shows up in the right place. And there it is. That's the 9% vol portfolio. And let's talk about how to buy it. So if your client wants a 9% vol, relatively safe portfolio, and they have $100 to spend, I would tell them to put $44.53 in treasuries, $42 in SPY fund, $13 in an EMA fund. And then lastly, what if your client wants a 27% volatility? That's way out here. That's going to combine this portfolio, which is our leveraging portfolio, and borrowing at 5.5%. So let's calculate the weight of the risky in that portfolio. It's just going to be my desired volatility of 27 divided by the volatility of my borrowing portfolio, 21. So I'm going to put 128% of my money in this portfolio, which means 1 minus that is borrowed. Again, I got to change formats. Excel always wants to add too many decimal places. So if I had $100 to invest and I want 27% vol, I would borrow $28 at 5.5% and put $128 into this portfolio. The expected return of that portfolio is I have negative 28 invested at RB. In other words, that's my interest charge, plus 128% of my money earns the expected return of that risky portfolio, 744. So I get 7.98%. And then lastly, how do I build that portfolio? Well, 128% of my money is invested. I'm going to anchor that, F4. In SPY's weight, so 128% of the weight of SPY in the risky portfolio. And I'll just copy that. So that's how I build that portfolio. If I want it, and let me add it to the graph, make sure it works, because it should show up right up here. As long as that's 27. 27 might be closer to here. So I'll do a right click, select data, add, portfolio V3 has a standard deviation and mean. And let's see where it showed up. And there it is. That's your optimal portfolio for 27% vol. And if I had $100 to build that portfolio, I would borrow $28 at 5.5%. I now have $128. I'd put 6 in SPY, 32 in EFA, 89 in EMA. And then last thing, what if I wanted to attack the problem a different way? You couldn't articulate what risk you wanted, but say you wanted a 5% return. I could try to find a portfolio on this envelope, on this line segment that provides a 5% return, and then we'll pick two other levels of return, say 7. So if I want a 7% return, I'm going to get a portfolio right there. And what about an 8% return? If I want 8% return, I'll be right here. So I'm going to find the portfolios a slightly different way, and that is looking kind of in a horizontal direction. What if I want a 5, 7, or 8% expected return? So back to the PowerPoint. I'm now looking at areas of expected returns of 5, 7, or 8. I'm going to be on either this line segment, this envelope segment, or this line segment for leveraging. If I want a 7% expected return, that happens to be between the 6, 8% return of this portfolio and 7.44 of this one, or graphically it's between these two, so it's on the envelope. I need to run solver because it's on the envelope. So I'm going to run solver for a expected return of, what did we say, 7, 5, or 8. So my 7% volatility is a solver solution, data solver. That's going to minimize volatility. Maybe delete that constraint. and add a constraint that the mean is equal to 7%. Solver found a solution. Here it is. I'll copy that down here. So that portfolio is 55% SPY, 6.8 EFA, 38.6 EMA, provides a volatility of 722 and an expected return of 7. Change the formats on that. I always like to, anytime I put values in Excel, I try to highlight the numbers, so if I had to come back and update things, I know where to update values. And then the last two steps, what if I want a safe portfolio? Again, well, we can add this to the graph, make sure it looks right. Let's add R1 to the graph, and that R1 should show up right there. Move that back a little bit. So it should show up right about there. Second one's going to show up here later, and the third one's going to show up right about there. So let's just right click, select data, add. This one is called R1 for return target 1. Has a volatility of 17 and a standard deviation, or and an expected return of 7. And let's see where it is. And there it is. That's our portfolio, R1. All right, so that's in the right spot. And let's find this portfolio. A portfolio that has an expected return of 5. So I'm going to find a portfolio on this line that combines treasuries and the optimal risky portfolio. I'll use this, our equation of expected return of a portfolio that combines risky and risk-free assets. So a portfolio that combines risky and risk-free assets, the expected return is just the weight in the risky times the standard times the expected return of the risky plus the weight in the risk-free times the return of the risk-free. Solve that equation for the weight of the risky, and it's going to be the complete return minus risk-free over the risky portfolio standard deviation. I'm sorry, expected return minus risk-free rate. So let's go ahead and do that. The weight of my risky is going to be a ratio of my desired return minus RF, and that's the desired combined return, divided by the return of the risky portfolio, optimal risky portfolio, 6.8, minus RF. So again, I'm trying to find a point that combines this portfolio and treasuries that gives me a total return of 5%. That portfolio is 62.5% invested in the optimal risky portfolio. That portfolio is going to give me a volatility of 62% of the volatility of my optimal risky portfolio, 1623. Since the volatility of a portfolio that combines risky and risk-free asset is simply the weight in the risky times the standard deviation of the risky. I'll add that to my graph, make sure I got it correct. So that one again should show up right here. Select data, add, R2, standard deviation, mean, and let's see if it's in the right spot. There it is. Looks good. That portfolio is exactly at 5%. This one's at 7, and the last one we're going to do is for 8. Now for 8, it's going to combine this risky portfolio here, not the first one, and borrowing. So the formula is very similar. That portfolio is going to be a ratio of my total desired return, 8, minus RB, since I'm combining leverage, divided by the expected return of my risky borrowing portfolio, 744 minus RB. So that's 129%. Looks like I need to change a format here. Home percent. And by the way, we can calculate the weights over here too. I didn't do that. We can say that this portfolio is 62% invested in risky assets. And risky assets, I'll anchor that. And that portfolio is 76% SPY. So that portfolio would look like this. And my weight in my risk-free would be 1 minus 62%. So again, I didn't go back and do that, but that portfolio that we just calculated, R2, if you had $100, I put 37 treasuries, and the other 62 would be invested in my risky portfolio, which means 47 in SPY and 15 in EEM. And then back to this problem. If I wanted to get a 8% vol or a return, I need to have 129% of my money invested, which means 1 minus that. I need to have negative 29% of my money invested or borrowed. Let me copy these formats. Alt-EST, enter. So if I had $100, I'd borrow $29 at the borrowing rate of 5.5%. That'll give me a portfolio volatility of 129% of the volatility of the levered portfolio, which is 29. So I get a portfolio volatility of 27%. Before I go any further, I want to make sure I did it right by graphing this and see if it's on that line segment. So hopefully shows up right here. So right click, select data, add, R3 with that volatility and that mean, and hopefully we'll see it right here. And there it is. It's in yellow, so it's kind of hard to see, but it's right on that line. And lastly, the weight of that portfolio would be 129%, anchor that cell, times the weight of SPY in that risky portfolio, 4.8%. And then I can copy that formula, and here are my weights. If I want to build a portfolio with 8% mean, I would leverage it by borrowing 29% of my wealth. So if I had $100, I'd borrow $29 at 5.5%. That $129 is invested at 6 in SPY, 32.67 in EFA, and 90.16 in EMA. So that's our solutions. So in this exercise, we took estimates of annual returns and standard deviations and correlations for 3 risky assets. We combined them to make portfolios using the expected return and standard deviation formula for portfolios. And then using that, we built 6 efficient portfolios. Those efficient portfolios created my envelope, this curve. If there are no risk-free assets or borrowing, I'd buy one of those. However, if there is a risk-free asset, we run an optimization procedure to find a portfolio that is a tangency coming from the risk-free rate to the envelope. That's this portfolio here. So if there is a risk-free asset, I would invest in treasuries. Combining with this portfolio, I can get anywhere along this line segment. And then we determined that there is a borrowing rate of 5.5%. If you can borrow at 5.5%, you could lever this tangency portfolio and get these levels of returns out here. So now this is my entire portfolio choice. I would be on this line segment, this curve, or this line segment. And this line segment would stop to whatever my maximum borrowing is allowed. One caveat to all this, again, these estimates are only as good as our estimates of correlation, return, and standard deviation. If, for example, you believe that these correlations are closer to 1, you can plug those in and rerun this. If you think the volatilities of EFA or the expected return of EFA might be down given the market conditions, you could change that. So all I'm saying is all these assumptions, this model is just based on our assumptions of return, standard deviation, and correlation of these assets, and also assumes that all these assets are normally distributed, which is a big step to make that decision. So we know that when we build these portfolios, we were always a little nervous that risk return is not being fully captured by standard deviation. But having said all that, this is the solution making those assumptions. If you're interested in more, you can check out some books, Capital Ideas Evolving, Random Walk Down Wall Street, or a critique of a lot of these methods, Fooled by Randomness. Also, one thing we didn't get a chance to cover is if I say short sales are allowed when you run Solver to calculate your envelopes, you would just uncheck this box. That allows negative weights, which would allow a solution to have efficient portfolio have negative weights. Now, what that means is these weights would still add up to 100, but they would allow you to say short EFA. So you might have 60% in SPY and 70% in EMA and a negative weight to EFA, allowing short sales. So be careful when you're asked about running envelopes, or if short sales are allowed, uncheck that box. All right. Effectively, for most investors, they either choose not to do short sales or are legally restricted from short sales. For example, in an IRA or a 401k account, you wouldn't be allowed to do short sales. So hopefully you now understand what portfolio optimization means. It is creating efficient portfolios or envelopes, ones that maximize risk or minimize standard deviation. And then you combine those optimal portfolios, those envelope portfolios, with risk-free rates, treasuries, or borrowing to leverage them.